Welcome to another FAR walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over FAR Area 3. This is Section F, Remembering and Understanding. Identify the criteria for classifying a lease arrangement for a lessee. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. If you don't know much about our strategies, make sure you go to SuperfastCPA.com and sign up for our free 1-hour webinar training. We will teach you the key ingredients to passing the CPA exam, again, in 1 hour for free, so make sure you go sign up for that. Also, just letting you know, SuperfastCPA Pro members will get access to the full 10-question version of this video, where we're only going to be going over 5 questions in today's video. But again, SuperfastCPA Pro members get access to the full 10-question video so that they can get more practice and more understanding. So with all that said, let's dive straight into the questions. All right, here we are at question 1, and something I always like to point out is to read the last part of the question first. It might not always be helpful when you're doing like all the similar questions at the same time, but on test day, this will be a super helpful strategy because you'll be able to figure out the context of the question much more quickly rather than reading through the whole thing and then getting to the end and realizing what the question is. You immediately know what the real question is from the start, and then you read through the rest of the actual information and you know what you're looking for. So again, you do it to get context. So let's read the last part of the question. Based on the information provided, which specific detail causes the lease to be classified as a finance lease? Okay, let's go up to the top. Brilliant Spaces Inc., which is the lessee, enters into a 6-year lease agreement with Evergreen Equipment LLC, and so they are the lessor, for office machinery. The following terms are included in the lease agreement. The lease term is 6 years, and the machinery's economic life is 12 years. The machinery has a fair value of $120,000 at the inception of the lease, and the present value of the lease payments is $85,000. At the end of the lease term, ownership of the machinery will transfer to Brilliant Spaces Inc. for no additional cost. And finally, the machinery is not highly specialized and has alternative uses after the lease term. So we were given a whole bunch of information there. Based on all that information, what is the detail that causes this to be classified as a finance lease? So if you have no idea how leases work or what a financing lease is or anything like that, that's okay. We are going to be using these questions to figure out how leases are classified and what the different classifications are and what lead to those classifications. So again, if you don't know the answer, that's okay. We're going to look at the answer together to start learning how this all works. So let's go ahead and look at the answer. All right, here we are. The answer is C. The ownership of the machinery transferring to Brilliant Spaces at the end of the lease term is what causes it to be classified as a financing lease. So let's dive into this. We are going to be learning about all the different criteria that make a lease a financing lease. So one criterion for classifying a lease as a finance lease is if ownership of the underlying asset transfers to the lessee by the end of the lease term. In this scenario, ownership of the machinery transfers to Brilliant Spaces Inc. for no additional cost at the end of the lease, which satisfies this criterion. So the other details that were provided, they are not going to cause this to be a financing lease. Option A, the lease term being only 6 years, that's not covering a major part of the lease's economic life, and we're going to talk about that more in another question. In option B, the present value of the lease payments isn't a large enough percentage of the fair value of the machinery, so this criterion is not met. Again, that is another thing that we're going to talk about in another question. And the machinery having alternative uses does not contribute to classifying the lease as a finance lease. One of the criteria that has to be met is that it has to have ownership transferred to the lessee at the end of the lease. And I'm just going to say this right now at the beginning of the video. There are 5 criteria for classifying a lease as a finance lease, and only one of the criteria has to be met. So we're going to be learning about each one of them. If none of the criteria are met, none of the 5 criteria are met, then it is classified as an operating lease. And we're going to talk about more how those are treated differently in the next videos, how financing and operating leases are treated differently. But in this video, again, we are just learning how you classify a lease as a finance or an operating lease. And like I said, just one more time, there are 5 criteria. If one of them is met, it's a financing lease. If none of them are met, it's an operating lease. Let's go to the next question to learn about another criteria for a financing lease. All right, here we are at question 2. Based on the information provided, what criterion causes this lease to be classified as a finance lease? Let's go up to the top. Greenfield Industries, the lessee, enters into a 7-year lease agreement with Apex Machinery LLC, and that's the lessor, for equipment with a fair value of $200,000. The lease includes the following terms. The lease term is 7 years, and the economic life of the equipment is 15 years. The present value of lease payments is $120,000. At the end of the lease term, Greenfield Industries has the option to purchase the equipment for $10,000. The estimated fair value of the equipment at the end of the lease term is $25,000. So again, based off that information, which of these criterion is going to cause the lease to be classified as a finance lease? So we learned in the first question that one of them would be that ownership is transferred at the end of the lease. That doesn't seem to be one of the things here, so what is the new criteria that we're learning here? If you know, if you've seen this before, that's great. Then you already know the answer. If not, that's okay. We're going to look at the answer together to learn the next criteria. All right, here we are. The answer is C. The purchase option is reasonably certain to be exercised. So that's what's going to cause this to be a finance lease. So let's read through that. Another criterion for a lease to be classified as a finance lease is if the lessee is reasonably certain to exercise a purchase option. In this scenario, the option to purchase the equipment for $10,000 at the end of the lease term is significantly below the estimated fair value of $25,000, making it a bargain purchase option. This makes it reasonably certain that the lessee will exercise the option, meeting the finance lease criterion. Now, you may not always see it being significantly below the fair value. That might not always be the thing that tells you that it is reasonably certain to be exercised. In this case, that was the reason that we know that. But the thing you always want to be looking out for is that specific wording. If a purchase option is reasonably certain to be exercised, then that is a reason for you to classify a lease as a financing lease. So that is the next criteria. So we've learned 2 criteria so far: ownership transferring and a purchase option that is reasonably certain to be exercised. If either one of those is met, it's a financing lease. Let's go to the next question. All right, here we are at question 3. Which of the following fair values of the leased asset would result in the lease being classified as a finance lease? So let's go up to the top here. Northfield Tech Inc., the lessee, enters into a lease agreement with a present value of minimum lease payments totaling $150,000. So with a minimum lease payment present value of $150,000, what is the fair value of the leased asset that would cause this to be a finance lease? Again, this is another criteria. If you don't know how this works, that's okay. We're going to learn together. But if you know kind of how this works, then pause the video and do the calculation yourself. And when you're ready to come back, we will look at the answer together. All right, here we are. The answer is A. $160,000 is the fair value that would be needed for this to be classified as a finance lease based off of the present value of the minimum lease payments. So let's go through this. A lease is classified as a finance lease if the present value of the minimum lease payments equals or exceeds 90% of the fair value of the underlying asset. Therefore, for the lease to be classified as a finance lease in this situation, the present value of $150,000 must be at least 90% of the fair value of the asset. So let's walk through these. A is $160,000. That's the correct answer. And that's because the present value of $150,000 divided by $160,000 gives us a percentage of 93.75%, meaning that it is over that 90% threshold. And all the other ones are not quite meeting that. B was $167,000. That gets us to 89.82%. So it's almost there. It's almost at that threshold, but it's not quite there. So that one doesn't count as a finance lease. $175,000, as it gets bigger and bigger, fair value being bigger and bigger compared to the present value of the minimum lease payments, it's less likely for it to be something that would cause it to be a finance lease because, again, it has to be 90% or greater of the fair value. So the only one that meets that criteria is $160,000. So again, that is the third criteria for a lease to be classified as a finance lease instead of an operating lease. If the present value of the minimum lease payments is 90% or greater of the fair value of the asset, then that is going to cause it to be a finance lease. All right, now let's go to the next question. All right, here we are at question 4. Let's read the last part here. Which of the following economic lives for the machinery would cause the lease to be classified as a finance lease? So let's go up to the top. Aurora Manufacturing Inc., which is the lessee, enters into a lease agreement with Stellar Equipment Co., which is the lessor, for a piece of machinery. The lease includes the following terms. The lease term is 9 years. The machinery has no purchase option and ownership does not transfer at the end of the lease. The present value of the lease payments is less than 90% of the fair value of the machinery. And to classify the lease as a finance lease based on the lease term criterion, which of the following economic lives for the machinery would cause the lease to be classified as a finance lease? So this is the next criteria. And how long would the economic life need to be if we want to count this as a finance lease compared to the lease term? Again, if you know how to do this, if you've seen this before, that's great. Pause the video if you need to and do the calculation. If not, if you don't know how to do this still, that's okay. We're going to look at the answer together. All right, here we are. The answer is B, 12 years. That's the economic life that would be needed compared to the lease term for this to be considered a finance lease. So let's walk through it. A lease is classified as a finance lease if the lease term covers 75% or more of the economic life of the underlying asset. So to determine that in this situation, we take the lease term, divide it by 0.75, and that would give us the minimum amount of years that there would need to be for the economic life for this to be counted as a finance lease. So 9 years divided by 0.75 gives us 12 years. And so you can see A is 13 years, and that's just a little bit too high because it causes it to be 69.2%. But then we see B is 12 years. 9 divided by 12 gives us 75% of the economic life is the lease life. So basically, if 75% or more of the economic life is used up in the lease, then this would be considered a financing lease instead of an operating lease. And we can tell easily the other ones, 15 years, 20 years, those are obviously too high. They're going to make it so that it's not 75%. So that would not make it a financing lease. It would make it an operating lease if none of the other criteria were met for the financing lease. So that's the fourth criteria. Now we're going to go to the fifth question to learn the fifth criteria, and then we'll go from there. All right, here we are at question 5. Based on the information provided, which assets or asset, if leased, would be classified as a finance lease? Anderson Corp is considering leasing multiple assets. Each asset's characteristics are listed below. Asset A is a custom-designed manufacturing machine built specifically for Anderson Corp's production needs. The machine cannot be used by any other company without significant modification. Asset B is a fleet of delivery trucks designed for general commercial use that can easily be re-leased or sold to other companies. Asset C is a set of office furniture that complies with Anderson Corp's branding, but is standard enough to be used in other offices. And Asset D is a specialized piece of medical equipment designed for a hospital that requires minor adjustments to be used in other facilities. So with all that information, which one of these assets is going to be considered a finance lease if they leased that asset? Again, this is the fifth criteria. If you know it, then you already know the answer. If you don't know it, that's okay. We're going to look at the answer to see the final fifth criteria for a financing lease compared to an operating lease. All right, here we are. The answer is A. Only asset A is going to be considered a finance lease. So let's walk through this. The final criterion for a lease to be classified as a finance lease is if the underlying asset is of such a specialized nature that it has no alternative use to the lessor at the end of the lease term. So if the lessor has no use for it at the end of the lease, that, it's so specialized that nobody else is going to be able to use it, that would also make it a financing lease. So asset A, which is a custom designed manufacturing machine and that is tailored specifically for Anderson Corp's needs, and it cannot be used by other companies without significant modification, that qualifies it as having no alternative use, meeting the finance lease criterion. And then the other ones, it's pretty clear once we know that rule that they are not going to count as a finance lease. Asset B is the fleet of delivery trucks, and that's just general purpose equipment. It's, there's nothing special about it. Other companies are definitely going to be able to use it. Asset C, the office furniture is standard enough to be used by other offices, even though it is branded for Anderson, it's standard enough that other offices could still use it. And then asset D is the one that might have confused you a little bit if you knew this rule. The medical equipment, while somewhat specialized, because it is specialized equipment, is only specialized to the point where another hospital would only have to make some minor adjustments to be able to use it. So another hospital could use it if they got it. So that is the fifth criteria for a lease to be considered a finance lease. We've learned each of the 5 rules. We've learned the 5 things that cause a lease to be a finance lease, and only one of them has to be met out of the 5. Now, before we go do anything else, let's do one more part of the process called pillar topics. Now, remember, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice the things that keep popping up throughout the questions. You've seen 3 or 4 questions trying to teach you how to calculate the economic life versus the lease life to see if a lease is a finance lease or whatever the case may be. You see these things pop up throughout the questions, so you know these are important and you write them out as pillar topics in your own words. And by doing this each day, you are creating your own personal repository in your own words of the most important things that you need to know for the exam. So let's go ahead and look at the pillar topics for this video. All right, here we are at the pillar topics, and basically each pillar topic is just one of the criteria for something to be considered a finance lease. So let's go through them all one more time. Just a reminder, only one of these has to be met for it to be considered a finance lease. First one is ownership transfer. A lease is classified as a finance lease if ownership of the underlying asset transfers to the lessee by the end of the lease term. This is one of the most straightforward criteria for lease classification. It's pretty easy to spot this one. There's also a bargain purchase option. You might not hear it called that all the time, but basically the idea behind that one is a lease is classified as a finance lease if it includes a purchase option that is reasonably certain to be exercised. So if it's pretty likely that they're going to exercise that purchase option because maybe it's a good deal, or maybe they've stated that, yes, we're going to take that deal, then, you can use that as a criteria to classify it as a finance lease. And like I said, this typically occurs when the purchase price is significantly below the asset's expected fair value, creating an economic incentive to buy. And then the next one is the lease term, and this would be the majority of the useful life being used up in the lease. A lease is classified as a finance lease if the lease term covers 75% or more of the asset's economic life. This criterion demonstrates that the lessee is effectively using the majority of the asset's useful life. So that's why it would be a finance instead of an operating lease. Then there's present value of lease payments. A lease is classified as a finance lease if the present value of the minimum lease payments equals or exceeds 90% of the asset's fair value. This indicates that the lessee is essentially financing the purchase of the asset through the lease. And then finally, the fifth criteria is it would be a specialized/no alternative use. A lease is classified as a finance lease if the underlying asset is so specialized that it has no alternative use to the lessor at the end of the lease term. This typically applies to custom built or uniquely configured assets. So again, those are the 5 criteria for a lease to be considered a finance lease. If none of these are met, so let's talk about the last point here, operating leases. Only if none of the above criteria are met can a lease be classified as an operating lease. So this whole video, we've been talking about the criteria for a lease to be classified as a financing lease because only one of these has to be met for it to be considered a financing lease. There's 5 different ways, but only one of them has to be met. But if none of them are met, then a lease is considered an operating lease. And again, in the next videos, we're going to be talking about how that matters, like how it differs in calculation when you have a financing lease compared to an operating lease. But in this video, we were only focusing on the criteria for classifying a lease as a financing or an operating lease. And with that, we've learned a lot in just 5 questions and in the pillar topics. And that is the end of this video. Before you go, make sure you check out our Superfast CPA training webinar on SuperfastCPA.com. Again, it's only 1 hour, it is free, and we will teach you the key ingredients to passing the CPA exam so that you don't waste months or even years of your time failing these exams, wasting your money. Again, you want to check out that webinar so that we can teach you how to pass the CPA exam. And after you watch that, you're going to want to learn more, I promise. So check out becoming a Superfast CPA Pro member because Superfast CPA Pro members get access to a lot of great resources, mainly the Pro course, where Nate goes over directly and specifically exactly what you're supposed to be doing each day to pass the exams. But Pro members also get access to the full 10-question versions of these 5-question YouTube videos. So they will be able to practice another 5 questions with me so that they can learn a little bit more and make sure that this gets hit home a little bit more. So again, if you like this, if you like our other material, make sure you check out the webinar, make sure you check out becoming a Superfast CPA Pro member. And with all that said, I hope you liked the video. I hope it was helpful. If you did like the video, make sure to like it and leave a comment, and I will see you in the next video.